$85 billion. That's how much Alphabet is asking investors to hand over, while its stock posts the longest losing streak in more than a year. When we covered Alphabet's $80 billion fundraising plan in recent days, we said to watch how the market responded. Here's the update, and it's not pretty. Alphabet's stock is now on pace for its fourth consecutive weekly decline, the longest losing streak in over a year. And the company just revised that fundraising figure upward to $85 billion. CNBC reported that the company now expects capital expenditure to hit $190 billion this year, according to early reports indicating a significant acceleration from prior spending levels. Now, you're probably thinking, why does the richest search company on Earth need to raise money from shareholders? That's exactly what's making Wall Street uncomfortable. Alphabet has mountains of cash, but the AI arms race is burning through it faster than even bulls expected. Here's the thing. For anyone holding a broad index fund, Alphabet is likely one of your top 5 positions. A 4-week slide in a stock this large drags on the entire S&P 500. The risk isn't that Google fails at AI. The risk is that winning at AI costs so much that shareholder returns get diluted in the process. What traders are calling the AI dilution trap, spending more to earn less per share, is now the central tension in big tech. And that tension just got a lot more interesting. Turning to the IPO market, where SpaceX just made a move that hasn't been tried at this scale in decades. The Financial Times reported that up to a quarter of SpaceX's $75 billion float will be set aside for retail investors. We've been covering this story all week, and this retail allocation changes the game entirely. Most IPOs of this size give individual investors almost nothing. The shares go to institutions, and retail gets the leftovers at a markup. SpaceX is flipping that playbook. Now, here's the question you should actually be asking. Why? The answer isn't generosity, it's strategy. A massive retail shareholder base creates a floor of loyal holders who don't sell on quarterly misses the way hedge funds do. It stabilizes the stock. But here's the catch. Chinese investors have been explicitly banned from participating, according to Bloomberg. That's a geopolitical signal as much as a financial one. For your portfolio, the SpaceX IPO matters even if you don't buy a single share. A $75 billion offering absorbs enormous liquidity from the market. Money flowing into SpaceX is money flowing out of other tech names. If you're heavy in growth stocks, watch for a short-term rotation effect in the weeks after pricing. Most analysts stop there. They shouldn't have. Meanwhile, on the macro front, India just quietly printed one of the most impressive economic numbers of the year. 7.8% GDP growth in the January to March quarter, faster than any major economy on Earth. CNBC reported the figure came in well ahead of expectations, especially remarkable given reports of energy supply pressures that have affected global markets in recent months. Most people saw headlines about oil disruptions and assumed emerging markets would suffer. Turns out, India absorbed the shock better than anyone predicted. And here's why that matters to you, even if you've never bought an Indian stock. Emerging market index funds, the ones sitting inside millions of 401k target date funds, have India as their largest or second largest weighting. When India grows at nearly 8%, it lifts the entire emerging market allocation in your retirement account. But it's not all upside. Energy pressures persist, and India's dependence on energy imports means a prolonged energy crisis could reverse these gains fast. The question isn't whether India can grow. It's whether the world's energy choke points will let it keep growing. For anyone underweight international exposure, this is the kind of data point that challenges the assumption that only US stocks matter. Big stories, bigger stakes. Subscribe so you don't miss what's next. This has been The Financial Brief.